Hello there. Welcome back to Financial Accounting at 6. In this video, we want to look at a question from November 2023. This was question 7 on that question paper, and this was statement of comprehensive income. So the question reads, a statement of comprehensive income and fixed asset note, Cross Corporation. You are provided with information from the books of Cross Corporation. The annual year ended on 31 December 2021. So very important to take note of the where the financial year is starting and where it's ending. So this financial year is ending on 31 December 2021. So it means it started on 1 January 2021. So the financial year is from 1 January 2021 to 31 December 31 December 2021. So we can take note that this is our financial year. Remember, financial year is for 12 months. So this is what we have. So on the quiet part, it reads 7.1, we refer to information provided in calculate the missing amounts denoted by A to C on the incomplete fixed asset not provided. That's the first question that we are going to answer. Then we go to the next question. Uh, Prepare the statement of comprehensive income for the year ended 31 December 2021. So in this video, we are just going to look at question 7.1 and also look at question 7.2. So we go to the fixed asset note to try to see the indications or in terms of A to C and try to calculate their values. So we go to the fixed asset note in the question. So you'd see that this is the fixed asset note that we have there. Let's just try to check it. So this is our fixed asset note that we have. So we are going to calculate A, B, and C. So on A, we are seeing that this is addition and costs for vehicles. So what we are going to do is we are just going to check if we have got any disposals. You see that for vehicles, we don't have any disposals. Disposals have got 0 there. So it means nothing was disposed. So it's very simple to calculate. We can just look at the difference that we have on cost. So at the beginning of the year, we had 600,000 as our cost for vehicles. And then at the end of the year, we have 780,000 as our cost. So we can just find the difference between the two. So what are we saying? We are saying on A, we are simply just going to say 780,000, and then we subtract 600,000. And then from that calculation, let's try to see. If you calculate the two, you are going to get 180,000. So our answer there is 180,000. So this is our representation of A, and this is in rands. So this is what we have. Then on B, we check what we have, what we need to calculate. So we need to calculate the disposal at carrying value. The disposal at carrying value. So you might use the formula for saying for opening a fixed asset note of equipment, and then you put your balance opening balance at the beginning on the debit side at carrying value, and then your closing balance at carrying value at the end on the credit side. And then if you have got the total depreciation for the for that equipment, you put it on the credit side. And then if there are any disposals at carrying value, you put it on the credit side. Then the figure that we are looking for is the carrying value. Uh, we are looking for the figure for B, which is the disposal at carrying value. So you just get it as a balancing figure on the credit side. Then and if there are any additions, they'll be on the debit side. So this is another method that you might use. So we can just maybe try to summarize that method there. We are saying we can open a fixed asset account. In this case, we've got equipment whereby you say carrying value at the beginning on the debit, and then you also put your carrying value at the end on the credit, and then you have the total depreciation for that fixed asset will come on the credit side, and then the disposal at carrying value also comes on the credit side, and then the additions at costs, additions at costs will come additions at costs will come on the debit side. So the figure that is we are looking for is carrying value, disposal at carrying value, which is this figure. So according to the information that we have, we cannot use this method because we have some figures that are missing there. So what are we going to do? We can go to the additional information to try to see the explanation that we have in terms of uh, that that fixed asset that was disposed. So if you go down the information, if you go to 8, it reads that depreciation must return off on equipment at 15% per year using the diminishing balance method. Take note that equipment with a cost price of 18,000 rands and the carrying value of 12,000 rands uh, on the first day of the financial year, that is 30 September 2021, was sold to a director that is sold beer for 4,000 rands. So that's where we can calculate the carrying value of the equipment that was disposed. So we are being told that we are being given it as 12,000 at the beginning of the year. It had a carrying value of 12,000 and the cost price 18,000. So it means this non-current asset was then disposed on what? On 3rd September. So we know that our financial year is starting on 1 January. It's from 1 January to 31 December. And this non-current asset was disposed at 3rd September. So we can just calculate the number of months that non-current asset stayed. So we are seeing that it stayed from 1 January to 30 September. So we've got 9 months there. So it means we just calculate the depreciation for the year, then we multiply by 9/12 as a proportion of the months that stayed in the business. So the method that we are using also is diminishing balance. So we can just take note of the formula that we use when we're using diminishing balance method. So we are saying on diminishing balance, we are saying we calculate it as a percentage times carrying value. Where carrying value, we find it by saying costs minus accumulated depreciation. So at the beginning of the year, we are given the figure for the carrying value is already calculated is 12,000. So we are just going to say 50% times our 12,000 is our carrying value. So we are coming here, we are now saying 15% as a decimal is 0.15. Then we multiply by 12,000. 12,000 is our carrying value at the beginning of the year. Then the answer that we are going to get, we are going to multiply by 9/12. Since it said 9 months. So I will just try to calculate it as it is and try to see what we get there. So if you calculate that, you are going to get 1,350. So here we've got 1,350. So this is our depreciation for the 9 months of the year that that non-current asset was disposed. But the question, the question that we are calculating the carrying value at disposal. So to calculate the carrying value at disposal, you're just going to use the same formula that we say carrying value is equals to cost minus accumulated depreciation. Then if you go back to check the cost of that non-current asset that was disposed, we come here, you see that the cost is 18,000. So already we have got our cost, which is 18,000. So we come here, we are saying cost is 18,000. And then accumulated depreciation, now we know that at the beginning of the year, we are going to calculate the depreciation that we had at the beginning of the year. Then we add the depreciation of that current year to get the total depreciation. So we are saying, if you come here, you would see that the figures that we are given carrying value at the beginning and cost at the beginning. So to find the depreciation, so basically we are saying the carrying value is 12,000. We get it by saying 18,000 costs minus accumulated depreciation at the beginning, which we don't have. So we can find accumulated depreciation there by making it sub with the formula there. So if we uh, uh, put the like terms on one side, which means we are going to put 18,000 on the other side, then it becomes a negative. So we're going to say 12,000 minus 18,000 equals to negative accumulated depreciation. Then you subtract it there, we're going to get negative 6,000. There we get negative accumulated depreciation. Then obviously you divide by -1 both sides. You divide by -1 both sides. Then if you do that, you are going to get 6,000 is your accumulated depreciation. So this is our accumulated depreciation at the beginning. Then this accumulated depreciation at the beginning, we are going to add the depreciation for that current year to get the total accumulated depreciation on the date of disposal. So we are saying 6,000. We come here, we are saying now, we subtract cost minus accumulated depreciation, whereby at the beginning we had 6,000. Then we add the one that we calculated for that current year, which is 1,350. Then if you proceed, it means we are saying 80,000 minus, if you add there, you're going to get 7,350. Then if you subtract the two, let's try to see what we get there. We're going to get 10,650. So here we've got 10,650. So this is the carrying value at disposal. So this is the figure that we have representing our carrying value on the disposal date. So this that is our B. Then we can go to our C to see what do we have in terms of C. And on C, we are seeing that C is representing total depreciation for equipment. So total depreciation for equipment is now simple. What are we saying? We know that we've got 1,350 that we have that we calculated for that non-current asset that was disposed for the month that it stayed. For 9 months, we've got 1,350. Then we calculate the depreciation for that year for the equipment that were there for the whole year. So what are we saying? We are saying at the beginning, we had 280,000 as costs total. Then accumulated depreciation total was 70,000. And then if you subtract the 200 minus 70, let's try to see what we get. You say 280,000 minus 70. You're going to get 210. So here we have got 210 is our carrying value at the beginning. And then having our carrying value at the beginning now, we can now remove the carrying value at the beginning of the non-current asset that was disposed. So we can get that information on additional information there. So what I will say, remember the carrying value of the non-current asset that was disposed at the beginning of the year is 12,000. So we can remove it there because that one was disposed during the year. So we are saying the figure that we have there, which is 210, we subtract 12,000, that is carrying value at the beginning. So we are saying 210 minus 12,000. So we subtract the two. If you subtract the two there, let's try to see what we get there. 110, then we subtract 12,000. Then we get your 198,000. So it means as we've got 198,000 carrying value of the equipment that stayed for the whole year. So calculate depreciation. Remember, our depreciation rate is 15%. Now we are saying depreciation now is now 0.15, 50% as a decimal. Then you multiply by 198,000 rands. Then you calculate that the answer that you are going to get is going to represent for depreciation for the 12 months, which is 29,700. So we have for 29,700. So this is what we have for the equipment that's said for the whole. Then obviously now we are now saying the old equipment that's said for the whole. There we are saying now total depreciation. Total depreciation, we are now saying the equipment that stayed for the way, which is 29,700. Then we add the depreciation for the equipment that stayed for 9 months only, which is 1,350. Then we get total depreciation now. So if you add the two, the total depreciation is going to be 31,000, 31,050. So this is the figure that we have for total depreciation. So representing our C. So this is what we have in terms of the first part. Then the second part, remember, we are going to prepare the statement of comprehensive income. So if you come here, you see that this is our statement of comprehensive income for the year ended 31 December 2021. So remember, in the statement of comprehensive income, obviously, we are going to start with our sales. So we go to our question to check the figure for sales that we have in the question, in the list of balances that we are given. So if you come here, you see that the figure that for sales, you can look it in the list of balances. We are seeing that we have got sales there, which is 3,345,000. But we cannot straight away put that figure. We look if you've got any debtors allowances or returns in terms of sales in the question, so that we subtract from the figure for sales to get the figure for net sales. So I'll go down to check our debtors allowances. You see that in the list of balance, we don't have anything. So if you see that there's nothing in terms of debtors allowances there, you can go to additional information to see any adjustment that is affecting our sales. So you go through all adjustments, you come to additional information. You'd see that on the first item, it reads a credit note was issued on 31 December for 9,920 goods were sold with a markup at 60%. No entry has been made for this transaction. So it means this transaction is affecting our sales because a credit note is a source document that is issued when goods are returned after making sales. So they are going to be our debtors allowances. They're going to reduce the amount for sales that we have of 9,920. And it's also going to affect our cost of sales because we have got our goods that were sold that were not recorded. So it means we're going to calculate the cost price of those goods and also adjust it for cost of sales. So we go to our other section and subtract 9,920 from the figure that we have for sales. So if you come here, you see that the figure that we have for sales is 3,345,000. So we are saying there 3,345,000. And then we subtract the figure that we have for our credit note that was omitted, which is representing our debtors allowance. So it's 9,920. So we can just subtract it there. So we are subtracting 9,920. And then if you subtract there, we are going to get 3,335. 3,335,000. We can just maybe try to check there. We have got 80 there, 10,920. So it means it's going to be 3,335,080. Right. So this figure that we have. Then from there, obviously, we are now going to less cost of sales. So remember, we've got those returns of sales that took place, but we are not recorded. So they are going also to affect our cost of sales. So what we are going to do, we are just going to multiply there in proportion so that we get the representation in terms of cost of sales. So if you come here, let's just try to see in terms of adjustment. So it's saying goods were sold with a markup of 60%. So remember, the formula that we are going to employ there is going to be, let's just try to see the formula that we are going to employ there. So we are going to say for our selling price, we are going to say cost price plus markup give us our selling price. Then cost price is always 100%. The markup depends with the percentage that we are given in the question. In this case, we've got 60%, so we're going to say plus 60%. And then you get your selling price, which is around 60%. But so this 9,920 that we are given is selling price, so it's going to come here 9,920 representing this, and the figure that we are looking for is for the cost price, so that we adjust it on cost of sales. So we just say what we are given there, what we have is 160, and what we don't have is 100. Put it as a denominator, then you multiply by the given figure, which is 9,920. And then if you do that, the figure that you are going to get there, it's 6,200. So you are going to get your 6,200. So remember, this figure also, we are supposed to subtract it from cost of sales to get the net figure for cost of sales. So 6,200, we subtract it from the figure for cost of sales. So we come in, you'll see that the figure for cost of sales, they've got 2,090,625. Then you multiply 6,000, sorry, we subtract 6,200 then. So we go back there on the other section. or in brackets, we are saying 2 million, 2,090,625. Then you subtract 6,200. Then we figure that you are supposed to get there is 2,084,000, 2,084,425. So this is what we have. And remember, we are subtracting, we are saying less here. So we are subtracting. So we subtract there. The figure that we get there is 1,250,655. 655. So let's try to see. So remember this, when you say sales minus cost of sales, the figure that we are going to get there is our gross profit. So this gross profit is representing this figure. So we, after I believe that now we are going to go to our income section. So we're just going to try to find out in terms of other incomes that we have in the question. So we are saying, here we are saying plus income. So we are just going to go to the question and try to find out all the incomes that we have in the question. So let's go to the list of balances. So if you come here, you would see that we can start here from where we have got sales, then we get to check for other incomes that we have then. We've got rates and taxes, which is not bad debts, insurance, interest on loan. Then we've got rent income, that is here, that is representing income. So the figure that we have for rent income is 126,224, but we cannot put it straight away. You can go to additional information to see if you've got anything in terms of adjustments affecting rent income. So if you come here, you check all the information, you see that on two, we've got something to do with rent then. It reads rent was received up to January 2022. Take note, rent was increased by 12% on 1 August 2021. So the rent was increased on 1 August 2021 and it was paid up to January 2021. So what it does mean, we know that our year is ending on 31 December 2021 and it was January 2022 was paid also. So it means we've got 13 months that were paid. Then we try to look at how many months after the increase. It was increased on 1 January, so 1 August, sorry. So we've got August, September, October, November, December, then January. Then we count how many months when the rent was increased. We've got 1, 2, 3, 4, 5, 6. We've got 6 months. And it means that the remainder from 1 January to 31 July, the rent was not yet increased. So we've got 7 months before. So this is before increment, and this is after. So we can just try to put down a formula there that will lead us to the total for rent that we are given in the list of balance. Remember, the figure that we are given in the list of balance for rent represents the total amount that was received for rent. But we can just try to see so that we find the figure for the rent that was supposed to be received in January. Remember, this is a prepayment, and we subtract it from the figure for rent that we are given in the list of balances, so that will remain for rent for that particular financial year. So what we are saying is 12% was the increase of 1 August, which is 12% is relating to after, which is after the increment, which is for the 6 months. So we come here, just try to put down the formula by saying before we have got 7, let's just say let the rent figure before be x, so that it becomes simple for us. So let's just put it represent it as x. So before the increment, we are saying we've got 7 months. So if you say 7 times x to get 7x, then we add the rent after the increment, whereby we are saying we have got 6 months. We have got 6 months. So it means after the increment, it's now 100. 100% is representing this x, and then we add the 12% that was increased, so it becomes 112%. So as a decimal, it becomes 1.1. 1.12 is a decimal. So if you multiply 1.12, it means this was the representation of the rent after the increment. So we're saying 1.12 times x to get for 1 month, and then we have got 6 months after, so we multiply again by 6, just like this. So this is the same that we are going to do here by saying 1.12 multiply by 6 months after, and then we are saying 6x by 6x. So we get after, and then the total that we get is the figure that we are given in the list of balances for rent which was received, which is 126,224. So we come here, we are saying 126,224. So if you multiply 1.12 times 6x there, let's try to see what you get there. 1.12 times 6x, then we get your 6.72x. So here we are saying 7x plus 6.72x. Then you get your 126,224. Then we add 7x plus 6.72x. Obviously, you are going to get your 13.72x. So here we've got 13.72x, which is equal to 126,224. Then you divide by 13.72 both sides, so that you remain with your x on one side. So here we are saying 3.72. Then it becomes x is equal to, if you divide this side, there, let's try to see what you get there. Now we are saying 126, 224. You divide by 13.72. You get your 9,200. So your x is 9,200. So this is the rent. This is representing rent before. Rent before it was increased. The month that we are looking for is January. We are looking for January. And January 2022, it was increased. And when it was increased by 12%. So what we are going to do is we are going to say the 9,200 times 1.12, so that we get the rent after it was increased. So basically what we are saying, we can come here and say what we are saying now. We are saying 9,200, 9,200, then we multiply by 1.12. Then we try to see what do we get there. Then we get 10,304. So it means after the increment, it was now 10,304. So this is the figure that we are going to subtract for the total for rent, because this is for January 2022, which does not belong to the financial period that we are looking for. So we are going to subtract 100, we're going to say 126,224 minus 10,304. Then we get the net figure. So we go to our answer section for rent. So here we are saying rent. Then in brackets, we are going to say 126,424. Then we subtract 10,304. And the figure that we are going to get is 115,920. So this is the first income that we have. Then we go again to the list of balances to check the next income that we have. Go down with salaries and wages, consumer goods, interest on fixed deposit. We have got interest on fixed deposit is 2,200. So this is going to represent our interest income. So basically, this 2,200 represents interest that was received, but it doesn't mean it's the interest for that particular year. So we can check on the teacher information to see what explanation do we have in terms of interest on fixed deposits. So if you come here, let's try to go down to check information on interest on fixed deposit. If you go to 5, interest on fixed deposit was aimed at 8% per year. Take into account that the fixed deposit was increased by 30,000 rands on 1 September 2021. This transaction was recorded. So it means the figure that we have for fixed deposit in the list of balance, it has got 30,000 inside, and that 30,000 was received on 1 September 2021. So we need to see how many months that did it stay. you are sitting 1 September to September, October, 1 September, the whole of September, October to November, December. So we have got 4 months. So it means we have got 4 months of that fixed deposit. So we are going to multiply so that we get the interest income for that fixed deposit for only 4 months. So if we say 8% per year, you're going to get the annual figure, then you multiply by 4/12. Let's try to see what we get there. So we're going to say 0.08 as a decimal, 8% as a decimal, 0.08, then we multiply by 8,000, then we multiply by the number of months, which is 4 months. Is 4/12. Let's try to see what we get there. So if you multiply there, you're going to get your 800. So you've got 800 right there. That is that interest for interest received for those 4 months. Then we are going to add this interest to the interest income for the fixed deposit that was there for the whole year. So if you come back, we are going to say total fixed deposit that we have in the reserve balance, subtract 10,000 to get the net for fixed deposit that were fixed deposit that we had for the whole year. So if you come here, we are saying our fixed deposit. Let's just check the figure for fixed deposit. We have it here, which is 55,000. Then we subtract our 30,000 that came on 1 September. So we are saying 55,000. Let's just say here 55,000 minus our 30,000. So let's just try to see. So we are saying 55,000. Then you subtract your 30,000. Then the figure that you are supposed to get there is 25,000. Then you multiply. So it means this is the fixed deposit that we had for the whole year. Then you multiply by the percentage that we have there for interest income, which is 8%, 0.08. Just try to see 25,000, then you multiply by 0.08. You're going to get 2,000. So you get your 2,000. Then you add your 800 that we got for those of that for the fixed deposit that we had on 1 September, we got 800 then. So it means our total interest income is going to be 2,800. So you can just go and summarize on the other section. So if we come here, we are saying interest income. We are saying interest income. And we are saying we got by saying 2,000 plus 800. And the figure that we got is 2,800. So this is what we have in terms of interest income. Then we can also try to look for other. We have got equipment hired from member. We have also the issue of equipment hired from member. Let's go back to check that figure. And we have a figure that we have here for equipment hired from member, which is Sahara, which is 5,200, which we are also supposed to include there under income. So we come here. We're going to say equipment. Hired from member. The figure that we have there, it's 5,200. And then we also check for other incomes that we have in the question. If we go down and try to see other entries that we have there to check for other incomes that we have. Then we also have a figure that was pre-entered for discount received. So we have discount received figure that was pre-entered in the answer book. That figure is 3,800. So these are the all incomes that we have. According to the information that we have in the list of balances, we have got interest income and rent income, and then we've got equipment hired from member. Then after having entered all that, you have exhausted the list of balances, you need to check for provision for bad debts. Remember, provision for bad debts can be income, can be an expense. So if you check if there's a decrease, you have to put it under uh, income there. If it's an increase, you have to put it under less expenses. So we are going to check that. So we have got provision for bad debts. We can just check the how the provision changed from the previous year to the current year. So if you go to the list of balance, you see that provision for bad debts, that figure that we are given there is 13,050. Then you check in the additional information for the current figure for provision for bad debts. If you come here on item 4, it reads that the provision for bad debts must be adjusted 10,480. 10,480. So you can come here. We are saying we are comparing this with 10,480. So what does it mean? It means it's coming from 13,050 going to 10,480. So we can see that is a decrease. So we calculate the amount of decrease and put it under income because it's a income if it's a decrease. So we go back there again to check. So here we are saying provision for bad debts. So we can just summarize the working there in brackets by saying 13,050 minus 10,480, representing a decrease. And if you subtract the two, you're going to get 2,570. So here you've got 2,507. So this is what we have. And then obviously also you need to check if you still have got any other income that we have. Let's try to check there. So in this case, it means we have exhausted all the income that we have in the question. So we can add here to get the total. So if we add here, that is 150,920 plus 2,800 plus 5,200 plus 10,800 plus 2,570. The total that you are supposed to get there is 130,290. So we have got 130,290, and then we are saying plus here. So we add it to the figure for gross profit, which is 130,290 plus 1,250,655. Total will come here, and we are going to name the total. We are going to put the figure for the total figure, which is 1,380,945. So we have got 1,380,900. 745. So here we've got 745. And this figure we are saying we are going to name it operating income. So here is operating income. So we go beneath that. Now we are now going to list our expenses that we have in the question. So we are just going to say less expenses. Less expenses. So we are going to check all the expenses that we have in the question. We can go there and check the question from the beginning under sales. So if you come here to see that here we've got rates and taxes at the beginning, 72,500. And then we can put that 172,500 as rent and rates. So we've got rent and rates, and the figure that we are having there, it's sorry, it's rate and rates. we've got rates and taxes. So we can remove this rate that we have here and then put our taxes. So we've got rate and taxes there, and the figure that we have there is 72,500. Let's just try to see the figure that we have. We've got 72,500. Then we can go and check the next expense that we have. After rates and taxes, we've got bad debts. So the bad debts is 9,450. But before we enter that figure, we check if we've got any adjustment for our bad debts in the additional information. So if we come here, you'll see that on 4 bad debts of 8,360 must be written off. So we've got an addition of 8,360, which we must add to the figure that we are given in the list of balances. So we are saying 8,360. Then we add the figure for 9,440 to get the total for bad debts. So we come here. We are now saying bad debts, and then in brackets we are saying 9,150, and then we add 8,360. We add the total that we are going to get 17,810. 17,810. Right, we go and check the next expense. So after bad debts, we've got insurance. Then insurance is 26,500. We've got insurance for 26,500. Then we check for insurance information. We've got anything that is affecting insurance. Then if you come here, you'll see that on item 6, insurance included a policy with a yearly premium of 9,200. It was paid on 1 August 2021, and the policy expires on 31 July 2022. So what we are going to do is we've got this amount, 9,900, which was paid from 1 August 2021 to 31 July 2022. So the only months that are valid are from August to 31 December. Then the other ones we are supposed to remove them from the total figure that we are given there for insurance, because they do not relate to the current period. So we have got from 1 January 2022 to 31 July 2022, which we have got January, February, March, April, May, June, July. And then we count to see how many do we have: 1, 2, 3, 4, 5, 6, 7. So we've got 7 months that we have to remove. So we can say 7 over 12, then we multiply by 9,900. And then the figure that you are supposed to get there is 12,775. 5,775. So we subtract it from the total of insurance, because they do not relate to the current period. So we go there, and total for insurance that we have is 26,500. So we can go there and just summarize the working. So we are saying insurance, and then in brackets we are saying 26,500, and then we subtract 5,775. And then the figure that you are supposed to get is 20,725. And then after that, we check for another expense that we have in the question. So we see that after insurance, we've got interest on loan, which is a question mark, which means we have to find it as a balancing figure. Then we are going to adjust it after we've calculated the figure for profit. Beneath that's where we are going to subtract the figure for interest. So we can just leave it for now. Then we go to we've got rent income, we adjusted it, and then we've got salaries and wages, 175,000. So before you put 175,000, you go to additional information, check in other information that is affecting additional, which is affecting salaries and wages. Right, if you come to 9, saying one employee was omitted from the salaries journal for December 2021, his salary details are We've got net salary, employer's contribution, and deductions. So what does it mean? It means we are supposed to add back the gross salary. So the gross salary, we are going to say net salary plus deductions. Then we get the gross salary. So if you say 46,000 plus 14,500, you get the gross, which you are supposed to add to the one that is there, because this one was omitted, so it means you have to add it back. Then the figure for employer's contribution, you check in the list of balance if you've got any figure for employer's contribution. If it's not there, include it under salaries again. So it means we are supposed to add it. But if you go there to that it's not there, so you add 9,800 also. So all these figures we add them, the figure that we have for salaries there. Then we come there to check that figure for salaries and wages. So the figure for salaries and wages that we have is 175,000. So we're going to add that one. Salaries and wages. Salaries and wages, we've got 175,000. And then we're going to add those omissions whereby we have got 46,000. Then we add 14,500. Then we add again 9,800. So if you add those figures, you are supposed to get 245,300. So this is what we have. And we can go and check again any other expense that we have. So after salaries and wages, we've got consumable goods, which is 62,540. 62,540. Then we go to additional information. Remember, this consumable goods just represent the consumable goods that were bought. But you need to look for the consumable goods that were used and put it in the under less expenses. So if you go to additional information, we got that information. We go down to check where do we have anything to do with consumable goods. Try to see. So if you come to item 3, it reads consumable goods used during the year amounts to 54,368. So this represents the consumable goods that were used. So it's already calculated. So you can just pick it as it is, 54,368. So we come back there, put the figure for consumable stores. So here we are saying consumable stores. So the figure that we have is 54,368. And then we also have a figure that we have there, which is pre-entered, which is for members' salaries. So we also have members' salaries, which is an amount of 9,000. Then we check the next expense that we can put there. But if you check there, we would see that we also have, let's try to see, we've got a figure for sundry expenses. That is 124,500. Then you can check on the additional information if you've got anything that is affecting sundry expenses. You go down for additional information. So if you go down, you'd see that we have nothing to do with figures that are affecting consumable stores. So we're just going to take it as it is, which is 124,500 here. So here we are saying the figure that we have there is sundry expenses. The amount that we have is 124,500. Then we check again if you've got anything in the list of balances. So other standard expenses, we've got equipment hired from a member, which is we already adjusted for that. Then we go to additional information to check if we've got anything again that is affecting. Remember, we might have some depreciation also can be part of our expenses. We need to check for depreciation and any other in terms of additional information. But if you come to 7, you'll see that we've got something that is to do with the expenses there. The business sells plastic bags to these customers at 50 cents each. The profit or loss on sale of plastic bags reflects the following. So we have a cost of plastic bags purchased 51,200, cash receipt from sale of plastic bags 6,600. Then we've got the business uses the periodic stock system for plastic bags. No entries have been made for the vessel of the stock on hand at the beginning of the year, which is 5,700. Bags bought on credit in December 2021, which is 12,800. Then stock on hand at the end of year 3,600. So this is what we have. So basically, we are going to say what we had in the beginning plus what was bought, and then we subtract what was sold and what is remaining at the end of the year. Then we get what was the loss or the loss of the profits. So let's try to see. At the beginning of the year, we had 5,700. So we are going to say our 5,700, we add it to what was purchased. We are seeing that we have 1,200 that was purchased there. Here, cost of plastic bags purchased 1,200. Then this one was sold. We are supposed to subtract it to get a little bit for now. Then we go to reversal of this one. We've already adjusted it. Bags bought on credit. This one was bought again. We add again 12,800. And then now we have stock on hand at the end, so we're supposed to subtract it. And then we subtract also what was sold, 56,600. Then we see the answer that we are going to get. Figure that you get there is 9,500. So if you have got an outstanding figure like this, it means we've got a loss or a profit. Remember, if we calculate it correctly, if there's nothing in terms of excesses or deficits, you're supposed to get an answer of 0. So if you have got a positive figure, so basically what it means when you have got a positive, it represents a loss. When we have a negative, it represents it's just a surplus. Got a surplus, which means we are supposed, if it is a surplus, we are supposed to put it under income. So in terms here, we have got, in this case, we have got a positive, which is a loss. So we put it under other expenses. So we want to put 9,500 there is our loss. It's going to be loss on asset disposal. So we go there. So we are saying we've got something there in terms of loss, asset disposal. So we are saying loss on asset disposal. Then you can just summarize the working there. We said 5,700. We added 51,200. We added again 12,800. Then we subtracted 56,600. Then we subtracted 3,600. Then the answer that we got there was 9,500. So this is what we have. Then we also have depreciation is the only remaining expense. So we go there to check in terms of depreciation. Remember, we've already calculated here. When we calculated A to C, we got our total depreciation for equipment being 51,000. Remember, it was 51,000. It was 31,050. So for equipment, we've got 31,050. We calculated it when we were calculating on the first part, that is here. So we now want the depreciation for our vehicle. So we go to that fixed asset note again. to check all the information that we are given. So this is our fixed asset note, and then depreciation for the year for our vehicles is 138,000. You see, so they will say 138,000 to 80% for equipment, which is 31,050. 138,000 there is for vehicles. Then here we got 31,050. Then we add the two to get the total depreciation. So we come in here. So in brackets, we are now saying 31,050. And then we add the 138,000. Then the answer that we are supposed to get there is 169,050. So this marks the end of our expenses. Then we add all the expenses. We add all the expenses and put the answer there on top in line with less expenses. So the total for expenses will come here. So we are saying if you add all the expenses, the figure that we are supposed to get 729. Let's try to see. Figure for expense that are going to get 729,103. And obviously we are subtracting it from there to get the total for profit before interest expense. So if you subtract 1,380 or 1,380,000, 1,380,745 minus 729,403, the figure that we are supposed to get there, we put it down there, representing your net profit before interest expense. So it means our figure is going to come here. So if you calculate it, you're going to get 651,342. And this one is profit, profit before interest expense. So this is our profit before interest expense. So this is our figure, 651,342. Then obviously after that, now we go to interest expense. But if you go to the question, this figure I'm not given it as interest expense, it's a question mark. So if you go back to the list of balances, let's just check. Let's check on the list of balances. Right, so the figure for interest expense, we are seeing interest on loan is a question mark, so it means we are not finding it as a balancing figure. So if you are given it as a question mark like that, you just leave it blank and then we come back to calculate it as a balancing figure. So we are going to leave the year blank for interest expense section, and then we go to profit before tax. So because if you subtract, if you say profit before interest minus interest expense, you get profit before tax. So here we are saying profit before tax. So it means we cannot find again the figure of profit before tax with, because um, we can check on the extra information if you can if you are given the figure of profit before tax or not, and then we try to see how we can calculate it. So if you go there in the additional information, let's just try to see at the end of the question what we have in terms of that. If you go to item 10, it's saying income tax for the year amounted to 180,000. So it means we are given the income tax. Then the income tax was calculated as 30% of the net profit before income tax. So it's as simple as that. So we have got our income tax is 180,000. So we are going to put our 180,000 as our income tax there. So we can just try to see in terms of now. Okay, we can just go. Let's try to put it. Then we can see how we can play around with the figures that we have there to find the missing figures. So if you come here, So we are saying profit before tax, uh, we don't have it there. Then income tax now will come after that figure. Profit, we don't have that figure, and then profit before tax, we don't have it, but we have got income tax. So it means beneath that now we have got income tax here. And this is the figure that we are given is 180,000. So we are saying here we are saying 180,000. And obviously put it in brackets since we are subtracting. So we can now calculate the figure for profit after tax. Because here we are going to have our profits after tax. So we can just use proportion to find the figure for profit after tax, and also use proportion to find the figure for profit before tax. Then with that, we can now find the figure for interest expense. So we can go back in the transformation and now calculate the figures for profit before tax and profit after tax. So with the figures that we are given here, it becomes simple. We are already given our tax is 30%. So what you have to know is that profit before tax, profit before tax is always represented by 100%. And then depends with the level of tax that you are given. In this case, it's 30%. So it means our tax is 30%. And then profit after tax now, we get it by saying profit before tax minus tax. So we are going to say 100% minus 30%, then you get 70%. So 70% is profit after tax. Profit after tax. Then we can use the representation in terms of the 180 that we are given. 180 is being said is the tax, which is 30%. So it means our 30% is 180. So you can just make a proportion to find profit before tax and after. So let's start by profit after tax. So to get profit after tax there, it means you want the 70%. So it means this is what we don't have, becomes the numerator. What we have is 30%. So denominator, then you multiply by 180,000. Then you get your profit after tax, which is going to be 420,000. So get 420,000 there. Then to get profit before tax is 100%. So we are just going to use the same procedure of proportion. What we want is 100%. So 100% over 30 that we are given times the given figure 180,000. Then we calculate there the figure for profits before tax, you get 600,000. So these are the figures that we are just going to put there, all the missing figures. So go back, put those figures. So we are saying profit before tax, the figure that we got there is 600,000. So we are saying 600,000 here. Then after tax, we got 420. So we have got 420,000. So this is what we have. So it means this is the end, the final figure, which is profit after tax. But we've got a missing figure that we have for interest expense there. So remember, to get our profit before tax, we say the profit before interest expense minus interest expense, then we get your profit before tax. So to get your interest expense, we are simply saying this one, profit before interest expense, profit before interest expense minus profit before tax, which is 651,342 minus 600,000. And then the answer that you are supposed to get there is 51,340. Let's try to see 51,342. So here we have got 51,000. Let's try to see if you got, is this figure correct? Let's recheck there the figure for profit before interest expense. So we can just go up there to say profits before interest expense. We are saying 1,308,000. 1,380,745 minus 729,403. and then we get 651,342. 651,342. And then we recheck again in terms of the the figure that we have there, if it's going to lead us to the figure for our operating income. We are saying gross profit is 1,250,000, and then 1,250,655, and then we add 130,290, and then we get 1,380,945. So we go there to check if it's correct there. 1,380,945. So we see here we've got a wrong figure that we need to correct. So we have got 1,380,945 here. So what are we saying? We are saying we put 945 here. 945. So if you say this one plus this one now, the answer that we are supposed to get there, to get your profit before interest expense, you are supposed to get 651,542. So here we've got 542. So we are now saying to get this one, we are now saying 651,542. So if you say 600,000, 651,542 minus 600,000, we get 51,542. So this is your interest expense. So this marks the end of our question. Those who have subscribed, please subscribe and share. We are still coming with more videos. As for this video, I'm signing out.